Hey everybody, Preston Brent here with our Trader User Group Weekly Roundup. This is for the trading week ending March 8th, 2019. Well, are we stuck in quicksand? Are we slowly sinking? Or is it just a very shallow mud hole and we'll be able to climb our way back out? This past week, we saw the S&P down about 2.16%. The Dow was down 2.2%. NASDAQ was down about 2.4 and the Russell was all the way down 3.6%, while volatility was up. It moved up. Last week it closed at 13.57. This week it closed at 16.05 for a rise of about 18.27%. So we've seen a little bit of risk coming back into the marketplace. We'll take a look at that in just 1 minute. And naturally, when you've got a risk off kind of week, then the sector that tends to perform the best are the risk off sectors. And we saw it this past week with utilities up actually 0.63%. And the worst performing sector for the week was healthcare, down almost 4%, coming in, I think, down 3.98%. So really a bad week for healthcare. The current PE ratio, the forward ratio, is around 16.2, which is up about 18.5% from this time a year ago. So we've still seen a reduction in forward earnings. They'll probably continue to come down just a little bit, as we move forward in time. And I was telling our members this past Tuesday, 10 years ago, in fact, from this past Tuesday, the S&P touched an intraday bottom, which kind of defined the Great Recession that we had in 07, 08, going into 09, finishing up in March of 09, exactly 10 years ago. Now, since then, the S&P is up an annualized 17.6% since that low that we made on March 6th, 2009. And that's well above a 70-year average that we've had, really going all back almost to 1950. We've averaged about 10.2% move higher in the S&P. And since the 1900 area, over a century and 19 years, we've averaged about 6.4% after inflation has been taken into account. So we're well above our average run rate, our band, our longer term trading band. So I would anticipate over the next 5 years, 7 years, we're not going to see some of this strong growth that we've had clearly off of our March 6th recession lows back in 2009. So that would, and we could have, a quarter move or a 2-quarter move like we've seen in Q1 to the upside. But over the annualized periods going forward, I just don't see us maintaining the pace that we've maintained. Okay. Even going back to 1950, we're well above the average of 10.2. So that would suggest a pullback of anywhere from 7% to 10% of our average annual gain. So just looking at stats, going back into our trading band for the S&P, that's kind of what I see. So that tends to promote slower growth going forward on average over the next decade. Now, we've also looking at the global growth story. I'm sure all of you by now are probably tired of hearing about it, but it's being led by China and Europe. We've seen PMI data coming out of China and Europe suggesting their economies are, slowing rapidly. And if we look at Europe, Italy's already in a recession. Germany just barely missed going into a recession by about 10 basis points on their GDP number. And they actually had one GDP print in Q3 of below zero. So, and Germany's the economic engine of Europe and is the largest economy that makes up the ECB. And let's not forget the Brexit, because they've got a key vote coming up next week. Or this coming week, and they're having some difficulty there too. So there's a lot of risk around the European Union. So we've seen all of that now. Not only that, we're seeing China and Europe come out with more stimulus. We saw the ECB meet this past week. Super Mario Draghi come out and say that they're going to keep the rates where they are, which is essentially 0 to below 0 in Europe, at least through 2019. And of course, here in the US, let's not forget the Feds. They're pretty much all but on the sidelines. In fact, we're seeing now a higher probability of a rate cut before the end of 2019 than a rate hike. So it's really amazing. It's such a shift since uh, Power Ranger Powell came out on December 4th and made that ominous statement where he said quantitative tightening is on autopilot. And we had the worst, that preceded the worst December we've had since 1931. And then, of course, we've had the best start to the year in quite some time when he came out on January the 4th and said, well, I'm just kidding. My bad. We're going to stay on the sidelines now, which is essentially the way the markets interpreted it. And, of course, the bond markets always get it right because interest rates were going down. The bond markets was suggesting there is going to be no inflation. And interest rates have been moving lower. So, as I always tell our members, you've got to understand the credit markets because understanding the credit markets will give you a clue as to what the equity markets are going to be doing. All right. And we did see this past Friday, February jobs data come in very, very low at about 20,000 jobs added. But, month to month, these numbers are really screwy, especially with the government shutdown we had in December. So if you look at an average over a 2 or 3 month period, they're really not that bad, the numbers. And it also showed wage growth came in a growth of 3.4% year over year, which is not bad. And unemployment fell from 4% down to 3.8. So all in all, those numbers are not bad. I don't see a recession for 2019, guys. We can be dragged into one, but I see the nearer term risk coming from Europe. And also, we've got the geopolitical event with the China trade deal. So if the China trade deal goes through, I see a couple of different scenarios. One is if the deal goes through and they do not lift the sanctions or the tariffs, right? The trade tariffs, and Trump does a wait and see, then I think the markets will sell off pretty good bit. They'll be disappointed. If he lifts the tariffs, that'll give the markets a boost. We'll run up. Then we'll have another little bit of a pullback leading up into the Q1 earnings. And then Q1 earnings are going to be very important because we kick those off in about 4 weeks. And everybody's going to be wanting to see where the forward guidance is going to be for Q3 and Q4 of 2019. So that's a little bit about what I'm seeing right now. And before I get started here, we also just released our new learning management system here on our website. I highly encourage you to come in and check it out. It's really cool. If you truly want a master's degree in options, this is a place to go. I think you should. I think you guys will like it. So I think we're coming out with offers on this thing in our master's program, as well as a member in our user group. So I'd highly encourage you guys to check it out. Okay, we're getting a lot of folks coming on board here. Now let's take a look at the charts here. Excuse me. You can see on the screen, I got the daily chart of the E-mini S&P 500 futures. We're pulling back here. You can see I've got a market map over here that plots volume over price, and the most volume occurred around 27.18, kind of back near our pullback point. You can see the, if I blow this thing up, you can see the cross of the 50 and the 200 EMA. Now notice this is the EMA, not the SMA, okay? But they both work. You can see here with the EMA where we had support right here, it's held us up. This is going to be a major support area for us, around the 2710. So I've told our members, we want to stay above 2700. If we break 2700, it could get a little bit ugly pretty quickly, okay? Now, if I just adjust this, and let me just edit my chart, and I just wanted to show you guys a couple of things here. If I switch over to the 200 EMA, and I take this 200 EMA and make it an SMA, watch the price. Right here, we're above the 200 EMA, and then when I switch it over to the SMA right here, notice here it moved up. You can see where it provided resistance, it provided support, and then we just barely closed above the 200 SMA to round out the week. You can see this daily candle right here where we really, this is a bullish, the way we finished the day on Friday was a bullish day, and we climbed right up to the 200 SMA. All right. So Whether you use the 200 SMA or the EMA, they both work. They both provide support and resistance. This tells us that algos and firms, big funds and money firms are using both. I think they tend to lead towards the EMA, but you'll see most of the TV talking heads using the SMA. But you can see either way. Now I'm going to switch it back to the EMA here on the 200 moving average because that's what I like to use. But I wanted to show you just where we close. Now going back to the EMA, you can see now it drops way back down in this area here, which is going to provide us also a lot of support for the markets here. Now, if I come over and let's just look at this on another chart. Okay, so remember the 2710, just north of 2700. If we look at another chart, let's put it on Bollinger Bands and use a fib node against the Bollinger Band. So if I do that, and let's just take it up here like this, what you're going to see now is the same chart of the E-mini S&P 500 futures plotted against the Bollinger Band, but rather than doing 2 standard dev, I've done 3. So the red line is a 3 standard dev away from the center line of the Bollinger Band. The center line is the same whether you use 1, 2, or 3, right? But the blue line is 1, the purple line is a 2 standard dev. And you can see where we've tracked a 2 standard dev. It's provided resistance all the way up. We finally broken through, and now the blue, which is a 1 standard dev away from the center line to the downside, is providing support. All right. Look at the fib node. The fib node is suggesting on a strong bull move up, generally what's a popular support point is the 23.6 fib node pullback, which would put us right there at 2701. Now, the bar chart I showed you earlier said around 2710. So this is a really good support point. Now, you can see I've also run a combination GAN and fib pullback point, and it gave me a range of from this shaded zone here to this little shaded circle here, and then it plots the midpoint, which is at 2650. So that would be a catch-all point for us in here, but I'm still sticking right now to the 2700 level. Okay. You can see on the buying and selling pressure, you can see the red line here on the ADX. The directional movement has moved up, so the red has moved above the green. So the buying pressure started picking up really very slowly about the last week in February, and selling and our buying pressure fell, selling pressure picked up rather towards the end of February. Okay. Now you can see where we're finishing right here on this. Now, one other chart I wanted to show you, because we use all of these charts, to just either confirm or see if there's any conflicting areas here that we should pay more attention to. And this one right here we use also in our user group is the Ichimoku. And if you look at the Ichimoku on a daily basis, and I'm not going to go in details on what all these lines mean, we have this covered nicely in our charting section on our option masters, but you can see here the steepness of the blue line and the red line. If they cross, it's going to provide a little bit more downward action here. And on the Ichimoku, I am showing a pretty strong support area, a couple of them actually. One around the right around where we are, around the 2738 area. Another one around the 2700 area, and then finally a stop all around 2635. So if I were to draw those lines on this chart, it would line up with my Bollinger Band and my bar chart that I've shown you earlier. You can see the cloud here has the width of this cloud suggests there is a huge support zone underneath us. We're above the cloud, so that does give us a bullish cant, but we've had such a strong move up here. Should the red line cross the blue line, right, that'll give us a little bit more of a downward pressure, probably down to around the 2700 area. And then we got massive support right around the 2550 area. I do not see us coming down and retesting the lows here at this point in time. Should the China trade deal fail and they walk away from the table, we will come down and revisit these lows. So just understand that. But this is the Ichimoku. It's given us pretty much the same thing. If I come into a 2-hour chart, which is a good swing trading time frame, you can see here we went bearish on the 2-hour back on the 5th of March. So that was earlier this week. We would have and we were pointing this out in our group as the market started turning a little bit bearish. And then on the cross right here on actually the 4th of March, right? On that big candle reversal here when we went up and then we sold all off, that was the sign to go bearish using the Ichimoku, because the Ichimoku is really good at calling direction on a swing trade time frame. Okay. And you can see here we've got overhead resistance with the red cloud up here in this area right here. So we're still in a bearish frame of mind on this chart. So I wanted to just paint all of these pictures for you here on the E-minis. Now, we had a bullish close, even though we finished in the red. It was a fairly good way to go into close just by nature of how the markets were moving, right? So I'm going to take you back, and we're going to go back to the E-mini on my original chart here. I just wanted to show you the various charts that we use. Now, in our option masters, we go through a lot of charting, because our philosophy here is risk management is the #1 priority. And then the second priority is bias determination. And then the third is strategy selection. Notice strategies at the tail end of the curve, not at the beginning, right? So, for all of you that get a lot of these emails promising untold riches, I wouldn't believe that crap. If you do, I got a bridge I'd love to sell you. Um, but we focus, once you understand risk management and the elements of risk management, and we got hours and hours in our option masters on covering risk management, then we go into bias determination, and you've got to get a little bit of an edge in the market, and that is going to help you with our strategy checklist or our trade checklist on how or where or why you're going to do certain option strategies. Okay, so this is the E-mini. Now, if we come over and we look at the Russell, which led the markets up, and it's also leading the markets down. Notice, and again, on the EMA, we're below the 200 and above the 50, and we have not had a cross in the 50 and the 200. The MACD is flat, and then we started selling off on February 25th, right? And we started that cross, which was a time to start looking at just picking up a couple of puts. In the markets, you can see the volume over price. The max area here is showing me around 1494. So it's that's where a lot of volume is taking place, all right? And then there's another big volume area up around 1571. So we're kind of sandwiched in the two. We've got to make a move on this to see which way we're going to go. We're in the red, the green, obviously, for 2018, but we haven't really moved like I would have seen or I would have liked. Now, I will say that if you look at the pivot highs that were made in October, we came right up and just about hit that. So we haven't gone beyond that pivot high in October. It's providing resistance. It's the same across all charts. And until we get clarity on the China trade deal, and then I think if we get some clarity also on Brexit, China trade deal first is probably the primo for the markets, and then after that we'd be looking at Brexit. But this is kind of where we're sitting here. I do see we could pull back a little bit more, but I don't think we're going to go too far down. And by the same token, I don't think we're going to go too far up. This is just profit taking in my mind right now until we get clarity on just what this China trade deal actually means. Okay. If we look at NASDAQ, you can see on NASDAQ, we also had a cross in the EMAs on the 50 and the 200. Same thing, right? And let me just move this up. We started off the week at a high point, and we've just been selling off. But you can see here the daily candle on the NASDAQ as well was very positive, very conducive. And you can see this value area right here is around 6,900, which is right around where the cross of the 50 and the 200. Okay. So I just don't see too much downside on this thing yet. Now, if I look at an index of some of the FANG stocks, speaking of some of the technology, you can see we still haven't gotten the cross in the 50 and the 200. They have kind of moved up, but the MACD is basically flat. And if we look at the pivot points, we've taken out a prior pivot point that was made in November. We have not taken out the early November and then the October pivot points in this case here. So, and the volume area, the high volume area for this is around 6,100. So we're slightly above, but almost right on support for the FANG stocks. Now, they have not assumed the leadership role that we've seen or normally seen over the past 3 years. Other stocks, cloud-based and software stocks in NASDAQ have kind of led the way. Okay. And then, of course, if we look at the Dow, right here. You can see on the Dow, the 50, it's from a charting perspective, the Dow's chart looks much stronger. Okay. You can see the MACD is relatively flat until it started to cross to the downside back on the 26th of Feb. It's going to hold us up here. I don't see much downside in the Dow. We'll see if this momentum continues on from Friday's close. So basically, guys, net across all indexes, I see some profit taking, but I don't see anything serious right now. All right, this is just simple profit taking. I don't think we're going to get too much lower, but we did need to have a little bit of a pullback. I thought that was something that was just time in coming. We needed to have that thing happen, right? If we look at emerging markets, you can see in emerging markets now it came down a little bit harder because we had a strong dollar on Friday, right? I mean, you can see here the support area of emerging markets is a little bit over 40. I think this is going to fall a little bit. You can see that beautiful bearish divergence area that we had with emerging markets. So that movement here suggested going short emerging markets around the 2019 high that we made back on the 25th of February, right? And just picking up some shorts or some puts or taking profits off these lows here, okay? And then if we look at Asher, which is the tracking stock for China, this thing is going to be very strong. Now, it fell a pretty good bit, so it's going to encourage, I think, buyers to step in front of this thing leading up to a China trade deal. And it could be a low-cost way to make a play, right? So Asher could be an interesting play on this. And another way to play China is FXI. So if we take a look at FXI, you can see the same thing, right? We had this move lower here, but I think that just picking up a couple of out of the money call options, around 44, 45 strike area, 45 strike, I think we could see this thing. Should we get a China trade deal and the tariffs are off, we're going to take out these highs right here, 45, and move up to 46, 47 area, probably even higher. So that could be a really interesting low cost way to play the China trade deal. Okay, so that would be just one thing that I would take a look at. Volatility wise, well, if we look at the VIX, you can see here we're back into the yellow again, which is understandable given just the lead up to March and the huge drop that we saw in vol going from early January through the end of February. So this is just normal. We're in the yellow zone here. When we're in yellow, that basically means we have a higher propensity. The market, the volatility markets are very sensitive to upward pops. So don't be surprised if we get some bad news here. We're going to be back up in the red, which is over 30 in volatility. If we get some China trade issue that's really not good. But I don't think anybody's anticipating that. And just, I just think the way the White House officials and the way China is talking, like I said, the minute they announce a date here in Mar-a-Lago in Florida, then the deal is ready to sign. We're just not going to know the nature of it. But I think that would be, once you hear that, you want to go long some of the China equities and some other stocks here in the U.S. that play off of that. Okay, if we look at the front month term structure, you can see here that we actually closed just barely in a contango environment. Anything in the green here on the front month vol futures and the VIX, we're in a contango. Anything in red, we're in backwardation. You can see we're just we've been going back and forth, and the markets are not going to make a commitment and a bigger move one way or the other until we get clarity on China. And if we look at the back month, let's look at the back month term structure. You can see here Um, we've actually moved up, but we're still in a contango environment on the back month term structure too. Now this one is used to trade VXXB, and we've got a couple of really great series and lessons in our option masters on trading volatility, of which VXXB is a way to trade. It's the newer ticker from VXX. And I would expect as we move forward in time, more volume will come into it, but it's still a pretty good play to trade volatility if you don't want to trade options on VIX, or if you don't want to just go long or short vol futures. So that's a little bit about what I'm seeing in the volatility market, guys. Treasuries. Well, look at this. Treasuries are still holding up. We're in this range here, interest rate range. And you can see here, treasuries have moved up because money came out of equities this week. If we look at the interest rates, the 10-year rate, you can see we're down slightly below where the longer term volume average is here at about 2.68. We closed the week at 262. Okay. So volatility has interest rates have dramatically since the peak in, here we had a double peak. We had a beautiful signal here to go short interest rates. All right, that was a great signal. Or better yet, just go long bonds. And it's just a great signal. And as you can see, it turned out to be pretty good for folks that took the trade, which would be, going long TLT or short TBT on the trade here. I don't see too much more downside in this. I see some consolidation down here, and then if we can get out of this funk, you'll see the interest rate slowly drift higher. Okay, kind of a grind higher kind of thing. Currency wise, if we start with the British pound, because that's where all the madness is over in Great Britain, you can see here we're making higher highs and higher lows, but it's very volatile. And that's just the typical way the British pound trades. Okay, we had a divergence here to the downside. It could drop a little bit lower. We got a vote, which is probably not going to be successful in the British Parliament this week. Poor Theresa May. The volume here, the value area for the British pound is around 1.28. Okay. So, and then there's another value area up here at 1.31. We're stuck between these two value areas, which is where most of the volume and trading has taken place in the pound. So that puts us right in the middle here. Until we break out one way or the other, it's a no trade. And then, of course, the US dollar has been getting stronger. Look at this. We're the only pig in the pen with lipstick right now, and we're just moving up, more so because Europe is having trouble. And when Super Mario came out and basically said interest rates as low as we can go before going negative, their intrabank lending rate is negative, right? About 40 basis points to the negative. But you can see here this tends to strengthen the US dollar. All right, so the dollar is stronger. And if the dollar gets a lot stronger, it's going to put some headwind on our equity markets. Not enough right now, but it could. And then, of course, if we look at the yen, which is a risk-off trade, you can see here in Q4, the yen just went right through the roof. That was where money was going in a risk-off kind of environment. And then in Q1, it's come right back. It's like the mirror image opposite of our equity market. So think of the yen as a risk-off play for your portfolio, and you could go FXY to make the trade. And now you can see the yen is slowly starting to move up this week with a little bit of risk coming back into the market. All right. So that's a little bit about where I'm seeing. And then with the euro, as you guys know, my feeling on the euro, I think overall the euro is just destined to go away. Near term, it's a trading instrument. Obviously, I think it's going to come even lower. If I put it on a weekly chart here, let's just go out. Let's step it out a little bit. You can see on this weekly chart here as this thing paints on my screen. You can see where we're sitting on this thing right now. I mean, it's just it peaked out early last year in February of last year. Let me just see if I can get the things set up here. Let's go back to weekly. Here we go. There we go. So now you can see volume over price. I got multiple market maps. Each market map covers 90 weeks at a time. So this goes all the way back to the summer of 2017, which shows a value area of 116. It's going to come down to the next value area of 111.7. And notice that's exactly what we touched on an intra-week low at this value area right here. And then there's one final one down here that's at 1.06 to the dollar. And that is where I think eventually we're going to be heading in the euro, which doesn't portend very well for the US dollar if you're a dollar bear, because that just means the dollar is going to get a little bit stronger, right? Remember, it's a dollar index. It's not necessarily the dollar. So that's kind of what I'm looking at for the euro. Okay. If we come over and look at oil and energy, it is still hanging in there with what I said around the mid 50s. Okay. You can see we moved up to this area here, just slightly over 157 and a, or 57 and a half, but we're back down again into an area that I think it's where oil is going to stay, 54 to 58 area in the mid 50s for a little bit. Because if we're continuing to see a slowdown in global growth, it's going to put downward pressure on oil. Okay. I don't think we're going to come down and test this low down here around 42. But if you remember back down here, I was suggesting get long, and back up here, I was suggesting we get short. So right now, there's a no trade in oil. We're kind of sitting right where I think it would be. And now it's just a daily chop, right? If you want to day trade it, that's fine. But that's kind of what I see there with oil. And then, of course, if we switch over and look at gold, you know, I'm looking for this dip here to form a cup and handle pattern on a, as you can see, this wide rounded bottom, and then up we go with a nice little handle on a cup and handle pattern. We'll see if this in fact plays out. If it does, then the upside is up over 1450 to 1500. That would not be good for the equity markets, but it would clearly be good for gold buyers. But right now, I'm not ready to make that call. I was, however, down here suggesting long calls or short puts, bull put or bull call spreads, or just doing bull puts south of the price here, either in GLD or in gold futures. So that's a little bit about what I see here in these. We've got some other metals that we're looking at. And then in the ag market, meats and softs, there's some interesting things there, especially in the soft market. Things are starting to set up that members I'll review with you this Sunday evening. Okay, everybody, have a really great weekend. If you're not a member, I highly encourage you to come in and check us out. We've got a lot of good things going on here, especially with our new Option Masters software. It allows you to come in and view the videos much easier and do search and so forth on things that you may want to see. Okay, everybody, have a great weekend. I will catch everybody, our members. I'll see you guys tomorrow evening for our weekly market watch. Take care, folks. Ciao.